Hi, I'm Shae Russell here from Fat Tail Media, and joining me live is Adrian Day from Adrian Day Asset Management. Adrian, thank you for being with me today.
Well, thank you for having me, Shae. Good to see you again, virtually.
Yes, virtually. It's great to see you. Now, you're based in New York, I believe, right now?
No. I'm actually in Puerto Rico right now.
Ah, New York time zone. My apologies.
New York time zone, Puerto Rico, yeah.
All right. Now, we met last year, and I was fortunate enough to interview you last year for my subscribers back here in Australia. And the first question you asked me when you found out where I was from was, are the crooks still in charge? Now, the Australian mining industry has come a long way since then, but I have to say there was a particular part of my audience that absolutely loved your take on the Aussie market, because it really did capture the Aussie mining industry through the 60s and 70s, didn't it?
Yeah. But as you say, the truth is, the reality is things have changed considerably. And in fact, Australia has some of the toughest standards on, resource and reserve announcements and things like that. But generally, it's a mature industry now, and I think in the 50s, 60s, well, I wasn't around in the 50s, let's not go too far. I mean, I was around, but I wasn't in the mining business. But, in the 60s, 70s, there was a bit of a Wild West cowboy attitude. But no, that's really changed now.
It certainly has. And we're going to get on to what's happening in the Aussie mining sector later on. Now, first of all, obviously, we're really spoilt for choice on topics today. Let's kick off with, should people buy funds or should people buy individual stocks when it comes to mining? Now, this is something that baffles most investors. What do? Do they rush off and buy a fund? Do they buy an ETF and then not think about it? Or should people take the time to look at individual mining companies?
No, that's an excellent question, and I'll answer it honestly. We manage a fund, and we manage individual accounts. So if you like, I've got a dog in both ponies, a dog in both fights. Let's look at funds for a second. I am not a fan of ETFs generally, which tend to have a fixed allocation. They'll update it once a year or even twice a year, but it's a fixed allocation of stocks. And in particular, now there's some exceptions. I mean, the Sprott one is actually quite good. US Global has one that is quite good. They have criteria which they use to select their stocks. But if you look at the really huge ones, like the GDX and the GDXJ, they're so big, they can't select stocks based on merit. They just pile them all in based on size. And so when you're buying one of those, an ETF, you're basically buying the market. You're buying the good stocks, the bad stocks, the leveraged stocks, the conservative stocks, the stocks in high-risk countries, the stocks in low-risk countries. So, and frankly, I should also point out, in my view, the same applies to a lot of ETFs of smaller countries. Like if you look at the Brazil ETF, I mean, the top 4 stocks representing almost half of the fund are all resource stocks. Well, including the oil, including barley. Now, you may not want oil and you may not like barley for good reasons. But if you want to buy the Brazil fund because you want to bet on the emerging middle class in Brazil, but you can't get it in the ETF. Anyway, enough on that. But you get my point.
Yes.
You need to look what's in it. So I don't like the ETFs with the fixed, selection. But the Sprott one's good. The US Global one is good. Then you have open-end mutual funds. Now, the huge benefit to which are managed. Right? You've got a manager making a selection of what he wants to buy. He's buying, he's selling, he's buying this, he's not buying that. The huge advantage of a fund over doing it yourself is obviously professional management, we hope, and also diversification. So, if you're going to put $10,000 into gold for your grandson, a fund is obviously far and away the way to go. But I hope the fund sponsors don't kill me when I say this. I think most people who pick their own stocks will do as well as a fund. The problem is it takes a lot of your time and effort to follow the market. You can make mistakes, obviously, but if you do it yourself, you have a couple of huge advantages. And one is you can personalize it. So you want to take tax losses at the end of a year, you can do that. Whereas in a fund, you can't. And it may even be the reverse in a fund. There's a perverse rule in, I'm talking to US audience here, a perverse rule in the US. You know, when the fund makes its distribution at year end, all right, you have to pay your pro rata share of the capital gains for the full year, even if you've only been an investor for a month. Even if you lost money on the fund, you still have to pay tax. So the huge advantage for a fund is the diversification. So if you just can't be bothered, or don't have the time, I should say, you just plain don't have the time, or you're talking about a relatively small amount of money, 25,000, 50,000, you're better off putting it in a fund. If you're talking about $1 million, you're much better either doing it yourself or coming to a professional such as, you know, myself, for example.
Just throwing a name out there.
Yeah.
Okay, well, speaking, one of the things when it comes to being a self-directed investor, which is arguably what a lot of Sprott attendees are, they're trying to get more information to better manage their own investments.
Right.
Is it too late? And I suppose, you know, the stock market, especially in the US, Australia's a bit lagging. Have stocks gone up too far, too fast? Have people missed out on the gains, and should they just wait for it to pop?
And we're talking about gold now, obviously.
Well, yeah, gold's had one heck of a run.
Yeah. No, but I mean, we're not talking about the broad stock market.
No, I'm not talking about the broad stock market. Sorry, I should have been more specific.
Gold, yeah. You know, I don't think we're too late at all. And there's a couple of reasons. The first reason is that what the Fed did, the Federal Reserve and other central banks around the world, what they did in response to the economic hardship of the lockdowns that came from COVID, resulted from COVID, is an absolute game changer. The Fed has basically said, the Fed has said, there are no red lines. There are no red lines to what we will do. We are prepared to buy anything in any amount. So that is an absolute game changer. And for gold to go up the way it has gone up is a perfectly reasonable and rational response to what the Fed has done. Now, having said that, the Fed, and we call it over here QE infinity, the Fed is going to find it extraordinarily difficult to pull back from that. They were unwilling or unable to pull back from QE1, QE2, QE3, and that's history, so we maybe don't need to go into it too much, but let's just say they said they were going to normalize, and they didn't even go a quarter of the way towards normalizing. If they couldn't pull back from what in retrospect now looks like a very, very modest sort of increase in money supply, you know, it only went up, it only doubled. How can they pull back from what they've just done? It's going to be extraordinarily difficult. It's going to be extraordinarily difficult on a macro basis. It's going to be difficult on a micro basis. When you say to people who've been thrown out of work because of a government-enforced shutdown, sorry guys, your extra unemployment is running out next month. Sorry, it's not going to wash. They're not going to do it. They're going to have to keep going until the economy gets back. And so that is extraordinarily bullish for gold. Having said, so now let's look at the stocks. The second factor, have they gone too far, too fast? Well, they've certainly had good moves, as we know, you just said. Most stocks are up 50 to 100%, some a lot more. You look at the gold stocks on any measure you care to look at them. Stocks relative to gold. They are in the bottom 10 percentile that they've ever been. You look at gold stocks in terms of price. They're still down 60% from their 2011 highs, right? You look at gold stocks in terms of valuation. They're in the bottom quartile in terms of price to cash flow And we have something extraordinary now, Shae, in the gold stock market. We actually have free cash flow, and we have something called earnings, which
Yes.
most gold analysts, they're not aware of what earnings are, but we now have earnings, positive earnings. So the gold stocks are still cheap in terms of valuation, right? But they're also far better companies than they were in 2011, 12. I don't know what it was like in Australia, I really don't. But over here, something like 3/4 or more of the top people at the top 20 mining companies were either fired or decided to take more time with their families. And we had a complete rotation of top management. We've had a newfound discipline where there's an emphasis on making money. Can you believe that? Making money as opposed to just getting bigger. So better companies, a better environment, gold stocks still cheap, and gold, I think, at the beginning of a major bull market. And one more factor, if I may. Another thing that's very important, and I don't know how long this factor is going to last, but it's very important for now. 2004, 2003 to 2008, 2009, the margin in gold mining companies in North America did not budge. And the reason, despite gold price going up, and the reason it didn't budge was because what we call the commodity currencies, like the Australian dollar, South African rand, etc., Canadian dollar, they all went up significantly, increasing the costs of companies who had operations in those countries. The oil price went up significantly, and the oil price, as you probably know, is the #1 cost input for mining companies. We're now in a situation, and that's normal. It's normal when the price of gold goes up, the price of other commodities goes up, and the price of commodity currencies goes up. That's normal. What we're seeing now is something quite astonishing. We're seeing the gold price go up, but the oil price is extraordinarily low. And the commodity currency prices, I mean, the Aussie dollar's gone up somewhat in the last month, but it was extremely oversold a month ago. So on the context of a year or two, the Australian dollar is still very, very cheap. The Canadian dollar is still very cheap. South African rand, you know, all of these countries. So the gold mining, as long as that lasts, the margins are going to widen, and the company should be making a lot of money.
Yes, cash cows is what I think we call our gold companies here at the moment. They've just got more money coming in than they know what to do with. You've actually, when you talked about before we move on to our next session, when you talked about the reshuffle in management of gold companies in America and how they basically, you know, cleared out the cobwebs and rebooted what they were doing and looked, you know, rather than getting bigger, they decided to focus on actually, you know, making money. That happened in the Australian market in the late 2000s. A lot of our companies nearly went to the wall, and it's a conversation we can have another time because I don't want to bore you. Actually, I did an interview with a guy smarter than me who knows a lot more about it and went through it in depth. Basically, a lot of our companies nearly went to the wall. A lot of our management, we had no mid-tier sector, got completely cleaned out. So as gold peaked in 2010, 2011, our gold companies actually didn't do too well back then. So it's just
right. I remember.
Yeah. So we did that, but we just did it 5 years earlier than the US market.
Right. And your management, just generally, if you were to look at, you know, major Australian gold mining companies' management, you know, generally, I think you'd give them an A right now. I mean, they're good quality.
From the mid tiers all the way up to the big guys, but relatively speaking, in Australia, you'd be hard pressed to find a bad management team.
Yeah, absolutely.
They're ridiculous. Yeah. Juniors, you know, they're a hit and a miss. You know, that again, another conversation for later today. But the mid-tier sector in Australia is extraordinarily well run. Yeah. Again, topic for another day. We don't want that to dominate too much. But what we do want to talk about is the amount of money suddenly coming out into gold stocks or just into gold companies and capital raisings and capital placements. Now, I know from my own stocks that I recommend to my subscribers, in the past 3 months, I have seen more capital raisings come through, more capital raising announcements come through than I reckon I've seen in a year. What are you seeing hit your inbox personally? Because as a fund manager, you know, they're not coming to you for, you know, they're coming to you for a fund investment, not just a share placement for your shareholders.
Right. You know, I have a general principle, which is when you see in a good, strong gold market, when you see private placements, you know, coming out of the walls with very attractive terms, nice warrants, the odds are they're not the kind of things you want to invest in. The things you want to invest in are either the ones you can't get into, or when the market's really depressed. So the irony is that up until March, at the PDAC in March, which was before, you know, the crash and then the big rebound and QE and all that. So for, I would say, the 18 months before that, or let's say the year before that, we did more private placements in that single year than we've ever done before. In the last 3 months, and I'm painting with a broad brush, and I'm not knocking any particular company here, but there's a lot of companies offering money that, you know, I would never invest in, or the terms are just, you know, the stocks are just too expensive to be buying right now. So I would be a little bit cautious now, but I mean, you know, you just, or selective would be a better word. I would be selective, yeah. And I have people who say to me, they want to invest in every private placement. And, you know, and I think, well, that just doesn't make sense. The very first thing you've got to look at with a private placement is not what the discount is or what the warrant is and how attractive the warrant is. The first thing you want to look at is, do I actually want to invest in this company? And it's funny how people skip that step. So we will never buy a private placement if we wouldn't buy the same stock in the market at the same time. Now there's a lot of, you know, this is happening all over the place. A lot of Australians are offering private placements as well. You know, the Australians have, well, there's one big negative that the Australian, not just juniors, but the Australian market, frankly, but juniors in particular has, and we've talked about this before, and that is, you like to raise money by rights offerings to existing shareholders.
Yes.
And that is, in theory, that's a good thing to do. We need to raise money. Let's go to our existing people first. The problem is that retail investors in the US are not allowed to take up rights unless they're registered. Well, very, very, very few companies register their rights offerings. BHP, for example, a company like that might or might not, but the vast majority of rights are not registered. And there's a good reason for that. It can take you 6 months or 9 months to get through the SEC to register something. Well, you know, forget about that if we're just going to raise money from our shareholders. So if the rights, some rights are tradable, as you know. So if the rights are tradable, it's not such a big deal. I can't pick up the rights, but at least I can sell them. So I get something. But some rights are not tradable, and the US shareholders just lose.
Yes.
And so US shareholders who've been around any length of time, such as me, haven't had a proper haircut recently. So the gray is showing. You know, I hate to say this, but I start from a position of skepticism because, you know, when is your next rights offering going to be that I can't take up? That's the bad side. Now, the good side to the Australian, private placements is that there's no hold period. It's free trading paper when you get it. Now,
yes.
You still have to abide by the US rules, excuse me, but you don't have to wait a year, you don't have to fill out a whole bunch of paperwork, et cetera, et cetera. So that's a huge benefit for investors. So, you know, 6 of one, half a dozen of the other. But again, it really comes down to not Australia, not Canada, not this, not that. It comes down to, do I actually like the company?
That is a great lead-in for our next question, which is commodity cycles. Now, for decades, they followed a set pattern.
How was that a lead-in? There was no connection at all.
Adrian, this is why I like you. Thank you very
Sorry.
much. You're right. Do you know what? You're right. There was no connection at all. I was simply looking for words to put forward before I asked you the next question, and I chose the wrong ones while we're
Sorry.
live.
Okay.
That went really well. All right, let me try this again. Here is not a very good lead-in for my next question. Commodity cycles. We were talking off air about the impact the coronavirus have had on commodity cycles because we're not following the same patterns we used to. So could you please explain a little bit more about that?
Yeah, well, that's a huge topic, obviously. And I always like to say it's not so much COVID, but it's the lockdowns in response to COVID that have caused the problems. Yeah, because we've got two things going on at the moment. You know, an awful lot of people are talking about the reduction in demand that we expect, and you know, people aren't going to want to go out to restaurants or sports venues. We were talking about that earlier with Daniel earlier. So they talk about the reduction in demand and how long it's going to take and so on. But equally, there's a reduction in supply. And so, you know, people looking at just one side of it say, oh, we're going to have this deep deflation, long lasting. I don't think that's true. You know, clearly, let's just take copper as an example. On the surface, copper's a metal with a PhD in economics, as we say.
Yeah.
And so, do you say that in Australia?
We call it Dr. Copper.
Dr. Copper, yeah. Dr.
We shorten
Copper.
it. Everything about Australia is how short can we make the word?
G'day, g'day.
G'day, mate.
So you would expect that with a reduction in the global economy and with uncertainty about when the economy is coming back, with global trade slowing down, you would think that the copper price should have collapsed. But instead, copper is actually one of the best performing metals, other than the precious metals, one of the better performing metals this year. It's only down, I don't know, last time I looked, it was down 3-4% for the year. So one of the better performers, the index is down 20%. And the reason for that is obvious. Just as there's a reduction in demand, there's been a big reduction in supply, particularly from the Chilean mines, where they've had to close down because of COVID cases. Now, arguably, the supply side of that equation will be solved quicker than the demand side. In other words, the COVID situation, the actual illness at the mines will come under control, stricter measures will be put in, and they'll be able to resume production. But I don't think we're going to see new mines built anytime soon.
Okay.
And is Codelco, you know, at Chuquicamata, which is the world's oldest gold mine, a copper mine, I think, but certainly one of the largest and one of the oldest, are they going, they're in a process of going underground. Are they going to continue that? Or are they just going to, or are they just going to keep digging from this enormous pit in the ground? You have a lot of those huge holes in the ground in Australia, don't you? I love them.
Like, pretty much. We're just a country full of giant holes, really.
But again, Chuquicamata in Chile is, I don't know how big it is, but standing on the edge, looking at that enormous hole, big and deep. But, you know, if they don't, I suspect they're going to postpone the underground, which means production will not come back as quickly from that particular mine, and other mines are in similar situations. It will not come back as quickly as we expect. And in 3, 4, 5 months, let's hope, the economy comes back, demand comes back. So I think the metals generally, you have to be a little bit cautious, a little bit selective. I mean, I think in the short term, the copper rally is probably ahead of itself. Anything that's dependent upon the economy, I would be a little bit cautious of right now. Steel, iron ore, etc. But, you know, I think over the next few months, we'll probably get good opportunities to to invest in them. Those considerations don't apply to the precious metals, of course.
Yes, no, the precious metals seem to be in a league of their own at the moment. They're running at their own pace.
Right, right.
Now,
Well, sorry, go on.
No, I cut you off. You go.
Well, I was just going to say, a lot of people think, I mean, it's a mistake to think that weak economies are positive for gold. Everything else being equal, and everything else is never equal, of course. A weaker economy is obviously not good for gold because so much gold demand is jewelry. And even if it's not jewelry, you've still got to have the cash to buy the gold. So a weak economy, gold typically doesn't do well at the beginning of a recession. Gold responds not to the recession itself, it responds either to a credit collapse or it responds to anticipation of central bank easing in response to the recession. Whereas base metals, of course, actually are negative in recessions because demand goes down. Sorry, I just wanted to make that point.
No, that was actually a really good point, and I've made a whole bunch of notes of that, and I've got a daily article I need to write, and guess what I'll be talking about? Those comments. So that was perfect for me. I am going to ask you one final question, and this is just about any particular commodities outside precious metals. We know it's a fun time to be in gold and silver, but what are the other commodities that you're looking at to take advantage of, while the price is depressed right now?
Yeah, well, I'm not talking about now today because, most of, let's say copper, most of the copper stocks have gone up a lot. In fact, we're actually slowly trimming positions in the copper stocks. But I think if you look at, let's say now over a 2-3 month period, I think copper is very positive because of the fundamental shortage that we will see over the next 3 to 5 years. And I think we talked about this last time, I can't remember, but one of the things about copper mines is they tend to be large. We just mentioned Chuki. That is now 180 years old. Bingham Canyon is 110 years old. These are huge mines that last a long time, but they do not come along very often. So if you look at the largest 10 copper mines in the world by production and the largest 10 copper mines in the world by reserves, the last one that gets into the top 10 in either category is Oyu Tolgoi, and it's number 10 in terms of production. And before that, the last one that gets into the top 10 in either category, I think, or the top 5 at any rate, would be Grasberg, which is 1988. Takes a long, so these are, a big copper mine is a rare occurrence. Mm-hmm. And it also takes a long time for a copper mine from the time you say go to the time it starts producing, because they tend to be large, and the construction takes a long time. So the point is, if we look around the world today, we know with a high degree of certainty the maximum amount of copper that could be produced in 3 to 5 years, right? Mm-hmm. There is not, another way of putting that would be, in 5 years' time, there is very unlikely to be a major copper mine producing that we do not know about already. And so if the economy recovers and electric vehicles continue, there simply will not be enough copper in 3 to 5 years' time. There will not be enough copper. It's not there. And that means the copper price is going to go up. So I like copper a lot on that sort of time horizon. I think some of the other commodities are extraordinarily inexpensive. Oil is very, very inexpensive. So as a contrarian, you can start picking away, but I may be wrong. The problem with being a contrarian is you're either far too early or you wait, and suddenly you missed it. I don't think, yeah, well, there's a saying, Rick Rule likes to say, just because it's inevitable doesn't mean it's imminent, which is true. But I always add to that, typically the things that are inevitable You might wait a long time, but once they get underway, they tend to move very, very rapidly.
Yep.
But I don't think there's a rush to get into oil stocks, frankly. But I think if you look at ones with really strong balance sheets, that's the key. Really strong balance sheets, and you're prepared to be patient, you can pick away. Uranium, I'm a bullish on uranium on a, say, 5-year, 7-year horizon, but I'm much more skeptical or cautious in the near term. And the reason is a lot of people look at uranium, they look at the demand that's coming for uranium, the elasticity of demand, elasticity of price, we all know that, and the shortage, which we see right now. The problem with uranium is that those shortages are artificial, if you like. Cameco shutting down its largest mine in the world, in fact, and Kazakhstan restricting exports. If you get a higher uranium price for any period of time, Cameco can bring Cigar Lake and MacArthur, they can bring those back on in a few months. Kazakhstan can up its production in a few months. I mean, it won't be immediate, but you know, they could come back online in let's say 4 or 5 months. So there's a it's like having options out on a stock. There's a sort of cap on how high it can go, and that's in the short term, and that's not the case with copper. However hard they try, they cannot get increased copper supply in 6 months. So again, I would pick away at copper, but only when it's at uranium, but only when it's extraordinarily cheap.
Adrian, that is fantastic. Yes. Unfortunately, we're going to have to call time. I could have talked to you for a heck of a lot longer, I'll be quite honest. But we've got to call time there. That was fantastic. I would like to thank you very much.
Well, thank you very much for having me.
Oh,
I always enjoy talking to you.
Yeah. Oh, thank you. Do you know, I always enjoy talking to you simply because there's no fuss, there's no hyperbole. It's very much, well, no, I've seen these trends play out. Here's what I've learned from my experience with all of that. And I think that brings, especially for Australians, because we're a little bit sheltered when it comes to outsider knowledge. So it's great to see that perspective come from somebody like yourself.
You. Okay, thank you very much.
Thank you very much for joining me.
I appreciate it, Shae. Thank you.
I'll see you later.